That's really a very interesting question, that which metric to follow in the world of private market. First of all, there are a whole bunch of metrics. It's so easy for somebody to get confused. I mean, it took me a while. Even today, I get confused sometimes between the DPI and the IRR and the MOICs and TVPI and so on and on. But it is absolutely important that we look at the picture in entirety. You cannot actually pick just one particular metric and say that this is the game-changing metric. You start with something. A lot of people talk about the world of liquidity. Is the returns only on paper, or the fund has actually returned the capital? This is what the DPI is a measure of. The challenge is, if you only look at DPI, then there are fund managers who may have to compromise the long-term compounding, the long-term returns of a particular company to be able to give a near duration return so that their liquidity in the third year, fourth year, fifth year looks higher. Similarly, there is this whole concept of the IRR, which is the annualized returns that you can expect from this particular fund. Now, you can optimize the IRR if you manage your cash flows very effectively, if you manage your drawdowns very effectively. But that again is a challenge, because I, as an investor, when I have put that money aside for that fund, I would be looking for returns on the overall equation, which means MOIC, which is the multiple of the invested capital, becomes important. So at least when I look at it from my own standpoint, I genuinely look at these three metrics in coordination and a whole combination. DPI being a measure of the liquidity and how the fund has returned the capital over what period of time. IRR, which is an annualized measure in terms of how you deliver the returns. And finally, the most important one being the MOIC, so that I at least know that over a period of time, what multiple did I get on my invested capital. Other than these, there are some other factors which are more hygiene and clinical in nature, which is like dispersion, which means has the fund delivered a consistent track record, or there have been just one or two companies which have been rock stars, and based upon the success of those, the fund has returned the capital. But the important point is, so many times we try and make a judgment by ourselves. Here we need to actually rely on some of the experts who understand the industry well, who can do a combination of these metrics. And that's where I think, to the previous portion that we were talking about, the importance of diligence, verifying, making sure that these metrics are all working in cohort with each other. That's the important part.